So welcome to our Zoom call with David Beattie from Booster here with us today. It's Robbie Schneider, obviously, our clients. We're sending this message out. The last time we did a Zoom call similar to this was on March the 24th. And it was an interesting time because it was pretty much just when the markets were at a bottom and we were heading into lockdown with COVID in New Zealand. And here we are now, the 28th of August. And significant things have changed since. So the purpose of this video conference Zoom call out to our clients really is just to give an update of where things are at and look at how the recovery has affected your portfolios and how we see things heading for the future. So you may remember meeting David Beattie last time, and I'm going to hand over to you, David, just to pick up things from here. So thank you for your time again this morning.
No problem, Robbie. It's great to catch up again, and it's incredible to believe that 5 months has gone by so quickly, and such a lot has happened in that time, and extraordinary the way that the markets have reacted to a pretty significant global situation. And hopefully the messages that we sort of talked about back in the 24th of March when we were right in the middle of all this were relevant at the time, and we can now look back and perhaps reflect on some of that. So hopefully we've got a good chance to do that over the next 15 minutes or so.
Yeah, great. I mean, there was a fair bit of panic in that short space of time. I think, we saw 25 to 30% drop in less than 2 weeks across a lot of the markets. And just your thoughts quickly on what might cause a reaction like that in such a short space of time?
Yeah, I mean, the markets have been performing very well right up until February based on continuing global positive economic picture, supportive interest rates, company earnings were going along fine, but there was some concept or concerns that perhaps some of the valuations were a little high. And so when something like the virus hit from left field, it just caused a very sharp knee-jerk reaction that fed on itself and created a little bit of a mini panic. And of course, as we tried to articulate at the time and know now in hindsight, you make some of your worst potential investment decisions when you're letting your emotions drive those. So I think it was important at the time that we just helped to settle everyone down and make sure they didn't make emotional decisions. And as time has passed, that was absolutely the right thing to do. And if either you or I has suggested on the 24th of March that the level of the market recovery would be such that it would recover all of that and hit new highs within 5 months, we may have lost our license to operate because we would have been taken by men in white coats with our hands strapped behind our back. So I don't think anybody would have seen on the 24th of March a forecast that the markets would actually set new highs. Here we are in August. So it's probably useful perhaps to just give a bit of an explanation now why the message not to panic and just let the markets run their course was the right thing to do, and why, in a sense, this recovery has happened so quickly, and in fact is the fastest recovery from a market crash that the stock markets have ever seen, ever. So definitely caught everyone by surprise. And I think we mentioned at the time that one of the key aspects of this particular crisis, it was not a financial crisis, it was a health crisis that was going to potentially lead into who knew what in terms of economic effects. And it was quite different, therefore, from the global financial crisis. That was the first sort of point. But I think secondly, the world's central banks and governments learned a lot about the GFC, and their response to that gave them the confidence to basically throw the kitchen sink at this thing again, a second time, without fear. And I think that's been the key element that's driven the markets back up so quickly into the levels. Perhaps if I just show you a couple of slides just to highlight the sort of dynamics that has been going on behind that, with the huge amount of government and central bank support in the form here of government debt. So just before the COVID crisis, New Zealand's debt to GDP ratio was running at about 20% of GDP, which by world standards was very low and below average. that put New Zealand in a fantastic position for the government to really open up the support package which they have. And as we've seen, they have continued to not hold back in making sure that wherever support has been needed, that they have just opened up the purse strings. And whilst it looks a bit scary to think that our debt to GDP ratio is forecast now to go up to above 50%, as you can see on that line, and plateauing at about 55%, the important thing is that that's not at the expense of the government forking out a huge amount of new expenses by way of interest, because on the next slide here, if I can get it to work. There we go. And so whilst the debt to GDP ratio goes up from 20% to 55%, the actual government interest expense only rises from just over $4 billion a year to barely $6 billion a year. And that's simply a direct result of the low interest rates that have been caused by this massive amount of stimulus, with people all around the world, and including central banks, buying government bonds. So we've seen government interest rates fall to below 0.5%. So the New Zealand government, if they need to borrow another $1 billion, they can borrow that for 10 years on the market and pay an interest rate of 0.5% for 10 years locked in. So you can see that that gives them enormous capacity to borrow, in the words of the central banks and government, whatever it takes to support the economies through this crisis. And perhaps if there's anything we underestimated, is the extent to which the governments consistently all around the world were just going to absolutely apply that policy. So they can, I think importantly, they can continue to do this for a considerable period of time into the future. And there's an old expression, you know, don't fight the Fed. And the Federal Reserve is, like all governments, central banks, extremely supportive, with huge capacity with low interest rates to borrow. The last time in the GFC, I think we probably forget that the Federal Reserve kept the borrowing rate at 0.25% for 7 years. And I think, quite honestly, we're facing the same prospect, that we're talking about central bank base rates. In New Zealand, it's now at 0.25%, and our own Reserve Bank governor hasn't ruled out negative interest rates. And we're facing that prospect for at least the next 5 or 10 years, perhaps, which provides a massive underpinning for any asset that is driven by the level of interest rates. And that is flowing through into everything we're seeing. So definitely the stock markets, and is part of the reason why the housing market is still so buoyant, because it's given a whole lot of people confidence to go out and borrow, knowing that their interest costs are quite manageable.
So just on that, David, like through GFC 2008, 2009, and post that, we've had Europe, particularly Germany, have had negative interest rates for a good, potentially 10 years. Mm-hmm. And then we've seen the likes of the $2 trillion stimulus that Trump put in, whenever that was, in March, April. And these are the things that you're talking about and how they impact on our clients' investments, aren't you?
Yes. When people look at valuing stocks and stock markets, for example, which make up a big chunk of people's long-term retirement investment portfolios, and one of the key things you compare is the dividend yield, or the price to earnings ratio, or the earnings yield, and compare that to what are my alternatives in terms of bond yields. And with bond yields at 0.5%, pretty much around the world on average, including here, you don't need much of a dividend yield or an earnings yield from stocks to justify buying them. So that gap at the moment, even with the current valuations on stock markets, is up around 3%. So you can, the average dividend yield of around 3.5% versus a bond yield of 0.5% gives you a massive buffer. And whilst we're still going to face periods of volatility on the markets with all sorts of potential different influences, there might be it may be caused by a resurgence of the second wave, which is becoming bigger and bigger, or another left field event with China-US trade relations, which has sort of been parked into the background a little bit. So those things might come along and cause some more downside volatility. But we've seen the strength of the underpinning of that low interest rate floor. So it does mean that any corrections are probably going to continue to provide opportunities to buy back in dollar cost average. So I wouldn't be too worried about somebody who's sitting there thinking, oh, we might have a repeat of what happened during March. Yes, you might get the downside, but we've seen the positive rebound impact, and trying to get too cute and time that is pretty possible. Even someone like myself and other fund managers who've been in this game for 35 years or more, we're not going to try and time this market to that extent, because anyone who tried to do that in March would be significantly facing a massive dilemma right now, because they haven't reinvested back in with the markets at new all-time highs. That's a significant.
It gets down to the risk profiling, the age and stage of life that people are at, and the length of time in the market, which is what we're working with our clients. And it's interesting because I've had in the last month or two, had probably 10 people that have come to me and said, "Well, we invest in that's more safe than bank deposits, a similar kind of return." So the perception appears to me is that people are thinking that bank deposits aren't as safe as they used to be. They'd rather have a managed portfolio that's got some shares, some properties, some fixed interests, and bonds in one portfolio spread across different demographics, rather than put $100,000 ANZ in New Zealand, and that's the complete story of their investment. So, and then of course they're focusing on returns after that as well. But just some thoughts around that, because it's interesting. I've been 17 years in this business and really only seen that in the last 6 months, with people starting to think on a much bigger scale. They'd rather have assets, multiple assets, and multiple demographics. That was a safer investment than bank.
Yes, I'm not surprised that you're finding that level of inquiry now, and it is a direct response to the extraordinarily low level of interest rates. And I don't know whether you saw or your clients saw yesterday as well, ANZ have now decided to close the bonus bond scheme, which is $3.5 billion worth of money that's been sitting there as an alternative to term deposits, with that sort of element of hitting the jackpot every so often that people quite like. And the simple reason why they've decided to close it is they cannot sustain the level of earnings at these interest rates to continue to support the prize pool. So there's another $3.3 billion that's out there now going, well, what am I going to do with my money now? With the deposit rates so low. And I think you're right, it is appropriate for people to start thinking about, where can I just take on a little bit more risk in order to get some slightly higher returns. And that's a process that with your guidance and your experience will really help them to understand some of the dynamics, and some of the listed share market investments do have that element of volatility risk, which for a lot of people is a bit scary. But for a small amount there, some dividend paying shares are certainly okay. But I think one of the areas that we're very focused on at the moment, and have been for the last 2 or 3 years, even prior to this COVID event causing a spike up in volatility of listed securities, is to be looking a lot more closely at incorporating unlisted assets into our portfolios as a way to provide an alternative and diversified return stream, not just from the return, but also obviously from a volatility reduction. So we've been progressing down that path for a while now. And the one fund I think that really epitomises the opportunity set that is out there at the moment that we've set up is the Private Land and Property Fund. It is investing in primarily horticultural land assets in New Zealand that are just growing various crops. We've started with grapes, we've expanded into kiwi fruit, we're looking at avocados, apples, cherries, there's a whole hops, there's a whole range of horticultural crops that we can invest in with a fairly good quality credit on the other side. Kiwi fruit, for example, we've got a lease, 15-year lease with Seeker, and they're paying us a 7% rental yield on that land for us to just supply them with the kiwi fruit crop. So That's a good example, I think, of the available set of opportunities if you're prepared to move a little bit up the risk spectrum without, buying a listed property stock, which tends, unfortunately, to move up and down with the share market volatility, whereas an unlisted investment in, good New Zealand land that's fertile and growing a crop is not going to have that same sort of volatility in its underlying asset price. And is one that we can, as we just expand into more and more diversified types of crops and different geographical regions, get a nice, solid, stable cash flow coming through, which we're now pretty much at the point of being able to distribute on a quarterly basis, which will provide a nice regular series of 3 monthly payments to people, using the underlying yields of 7% as the basis for that distribution.
Mm-hmm. From our perspective, it's having that conversation with the client about the time frame, and a fund like that, would be typically somewhere between 10 years for an investment. To be putting that money there, it's not something you're going to put in and draw out 12 months later. Like all
that's right.
Good crops and trees and buildings and things, they need time to be able to grow. But yes, we've got a number of clients in that fund, and it's something that I'm quite passionate about, David, because we're getting New Zealand assets back in the hands, the ownership back in the hands of New Zealanders again. And, that we don't hear of foreigners taking all our prized possessions.
Oh, absolutely. And there's a picture there of just sort of a snapshot of some of the things we're invested in, and, beautiful countryside in New Zealand that's just taking advantage of our natural land assets with all sorts of great crops that are in demand worldwide, and we've not seen too much of an impact, importantly, during the whole COVID crisis. They're all deemed essential services, which was fantastic for the government to acknowledge that. So we were a bit concerned at the start that perhaps we weren't going to be able to pick the grapes off the vines literally back in March. We spoke, there was a bit of a question mark, and then that was confirmed, and so the grapes were picked, and it's a great harvest this year, top vintage, and there's going to be some fantastic wines that are being bottled now and exported overseas. The kiwi fruit is just going gangbusters. And so, there's these sorts of opportunities are out there as a really viable, good, solid alternative investment to not only term deposits, obviously, just there's a slightly different risk profile, but for people who have got even investment properties, they've got residential property, they may have a large enough pot to invest in commercial property, but that unfortunately tends to require a large chunk of money. This is accessible to anyone with $1,000, and to just provide some additional liquidity as well. It's listed on the stock exchange as well, so that just provides another alternative, which when you get into unlisted assets, liquidity becomes a big issue. So we've tried to solve that in as many ways as possible. So just remove that as an issue for clients. So $1,000 and you can own a piece of New Zealand land.
We also love the sustainability aspect to this, David, and I've been watching what's happening on Motiti Island with the avocado, particularly around the solar, and I think they're managing water now as well, so they're becoming a lot more efficient and less reliant on the grid. So there's a really nice story in a lot of those investments as well. And it's interesting, my grandfather was an apple orchardist down in Ruby Bay, near Mahana Estate, and he'd fought Germans in Egypt back, and he just got the orchard, and he said, this country, all we need to do is produce food, send it away to the rest of the world, and let them fight the wars, we'll just feed them. And it's interesting because, the whole COVID, a lot of people have likened it to a war of a different scale, but I think that's a large part of why these businesses are being successful, and we're going to climate throughout that period as well.
Absolutely. No, it's great advice, and we have a huge amount of confidence that this is the right type of investment opportunity set to complement somebody who's looking for an alternative income stream.
So we come across businesses all the time that are looking for money, investment capital, New Zealand businesses, and all that I've been to Duncan about who works at Booster. You're also involved in another fund here based in Wellington. Would you like to tell us a bit about that?
Yes. So, Yeah, we've always tried to, I'll just pop a slide up again now. We've always tried to retain a fairly innovative approach to our investment thinking. And I think one of the beauties of being a New Zealand-owned, more sort of boutique fund management operation, where the shareholders are predominantly the staff, where we're not driven by the same factors of some of these other larger, particularly bank-owned KiwiSaver fund managers who have different priorities and different goals and different financial objectives. We're prepared to take a much longer term view and can do. So we've partnered with Victoria University in helping them to provide funds for those potential ideas that literally come out of very bright postgrad students working out there saying, here's an idea, can we turn this into something commercial? So we're not funding the research, we're going beyond that. So our partnership with them means that they will come to us and say, here are half a dozen ideas that we believe have gone past the point of initial research and they have proven themselves to have a reasonable shot at commercial viability. So as a result of that, we've committed $10 million across our funds to support that, and invested in 10 different companies right now. We won't go through all the details, but it's a very exciting way of using, again, New Zealand money to support really bright New Zealanders coming up with ideas that have huge potential. We've also now just gone beyond Victoria University and have established a similar agreement with Otago University and made our first investment there into a drug testing kit that is able to pick up anabolic steroids much more readily and easily and across a broader range than is currently available. So that's showing massive promise around the world, and they're at the point of potentially rolling this out globally. As you can imagine, these types of new startup ventures, if you like, are high risk, high return. So we've got to be mindful of that. And so we're not committing a huge amount of money, but they're the sort of investments that, if they pay off, will generate hundreds of % returns and will make up for the ones that obviously potentially won't. So it provides a different, again, dynamic to the portfolios, completely uncorrelated with any other asset, unlisted, but I think most importantly enables New Zealanders, again, to feel as though they're using some of their money to support great things by New Zealanders and university brains that extraordinary, some of the things they're coming up with.
And thank you for sharing that, David. I mean, I think a lot of our clients are really comfortable knowing that the people that are managing their money are active about where the money is being invested, rather than just sort of sitting in an indexed fund and going to the staff and knows what is going on, where we can see and touch and feel that their money is going to, and their New Zealand businesses, land is story, because we've also seen Fisher & Paykel shares jump up, A2 Milk shares jump up in the short space of time. And you know, I've had quite a number of clients that have called me and said, am I involved in that? I said, yes, you are. It's one part of your portfolio, as well as all of these things. Back to that managed funds conversation, as opposed to just putting $10,000 in Paykel and hope that it does well. They've got up to 300-400 in their KiwiSaver, and that's spread out. Again, de-risking. Active management is critical.
Yeah, you're right. You can't do much with a passive fund, quite literally. You just have to continue to follow wherever that money goes, and you really struggle to be able to direct your investment money on behalf of the clients you're looking after into areas that are actually going to make a real difference. And if I just click on the next piece, you talked about active management. It has really come into its own during this volatile period. And I just grabbed a quick chart to demonstrate just how powerful having an active management component to the portfolios is. We're not all active, so we definitely have a core of the portfolio just sitting there in some index funds that capture the broad market performance. And then on top of that, we have these satellite active management strategies and funds that we use. And we've been using Rothschilds for over 15 years now to help us put together a global portfolio. And there's just 19 stocks in the portfolio, so it's very concentrated. And for the year ended March, every single one of those stocks in the portfolio outperformed the market index. And so collectively for the year, they generated a return which was 20% more than what the index fund just capturing the MSCI share index did. And that's an extraordinary outcome. You know, we're normally happy if we get 60% of our stock selections outperforming. This is 100%. And it can only be achieved if you've got a really good focus on the sort of companies that are going to work well in the thematics that you operate within. So you can see the list of stocks there. People own a share of those. Again, they can connect with those companies. A lot of them are just household names. Some of them not so familiar. Gordon, for example, people don't know that name so much. It provides all sorts of scents, as in SCENTS, and smells in a lot of the perfumes and general smellies that people use.
Fragrance.
Fragrances every day of the week, but probably don't even realize it. So that's the value of active management, plus 20%. And you pay a fair bit of money to achieve that sort of outperformance. I think more importantly, and that, I mean, they're part of the whole downside risk management area by having those sorts of stocks. And we've seen the value of that during the downturn, but it's not a matter of luck, because the key thing that we've also brought into our portfolios over the last couple of years, as well as having the socially responsible investment funds that you're familiar with, which allow people to invest in portfolios that literally exclude a whole range of industries that they don't want to invest in, full stop. It's a fairly blanket approach, and basically it removes all companies in all of those sectors, and that's fine. And having that choice is great for people to be able to reflect that, and particularly the fossil fuel thing. But before we get to that point, we've now fully integrated this ESG into our portfolios. So every single company that we invest in directly, including those ones I just talked about before, has to pass muster in terms of a range of environmental, social, and governance factors. And those are the broad headings that we use there to cover those. We're trying at the moment just to get the Responsible Investment Association of Australasia to certify all of this process. You can buy this stuff off the shelf, but we've looked at that and found that there's about 4 different varieties of ESG scores and factor assessment products available, and they all come up with totally different results, and they're not New Zealand based. So we've basically developed our own, and just wanted to reinforce the extent to which we've gone. This is not just us greenwashing or a whole lot of talk and no action. But to give you an idea, this is our ESG model for those stocks that I showed you before. You don't need to understand any of this. All I want to just highlight is that there are 11 environmental factors that we score these companies on. There are another 12 social factors that we score these companies on, and then a further 10 governance factors, and then we combine that in with the financial factors, and they come up with a score out of 100. And I can just plot them on here. So what we're looking for is companies that fit into that top right-hand box. So they have a high ESG score and a high financial score. And all of those companies there are in our direct portfolio in that box. And obviously we're trying to avoid any companies that rate down here. So we've fully integrated environmental, social, and governance factors across all of our investment portfolios. And then on top of that, if people don't want to invest in fossil fuels per se, or alcohol, gambling, those types of companies, then they can choose the SRI version as well.
So, you know, a completely sustainable long-term vision and view of investing, and looking after the people, and then looking after the environment.
And even no surprise.
No surprise, yeah. And in the last 5 years, David, you know, we've seen significant growth in that area and awareness of all types of corporate, and those that don't address it will get left mind. What do you think about that?
Oh, absolutely. I don't think you have to think too far to realise that a company that is thinking about properly and incorporating in everything they do on a day-to-day basis all of the key factors that make up a genuine approach to looking after the environment, looking after your staff, looking after your clients with your products, and thinking about how you're governed, all those sorts of things, it has to deliver a better outperformance over the long term than a company who's paying lip service to it.
And if anything that COVID's taught us is to slow down and think about the planet and actually do good things. And suddenly we've got pollution out of southern China and we can see the Himalayas and their fish are swimming in the Venice canals, and the world's starting to feel good again. For those of us that are still here, there's been some along the way.
And it may not feel like it. Sometimes it feels like there's some slow progress being made, but it comes in sort of waves, if you like. The tobacco movement really just went along quietly for a while and then suddenly kicked into gear, and companies operating in that space were really put under the pump. Controversial weapons very quickly in New Zealand moved to exclude all of those companies, and it's a process that sometimes can just very quickly put huge amounts of pressure. And I think the fossil fuels debate and climate change is putting massive amounts of pressure on these companies. And at worst, some of them, if they don't wake up and smell the future, they're out of business, and they recognise that. And so the more pressure we put on them, the greater is the possibility that they themselves shift into a more sustainable mode themselves, and we just keep doing that. It feels like sometimes we're a little country in New Zealand, but if you add our voice collectively to other like-minded fund managers on behalf of clients, very quickly you've got a big lump of money, and we sit and right in behind the New Zealand Super Fund, and whenever they put their hand up and say, these are things we're looking to do you want to join us, we're usually right in behind them.
Fantastic. And the Americans are interesting because I've had the benefit of being there a few times. Once the money stops coming back in terms of returns, that's when the Americans act. And an asset class like oil, for example, which has been relatively low for an extended period of time now, the Americans are starting to say, well, we're sick of not making the money we want out of oil. Where else are we going to go? But that's when it really starts to have an impact on momentum, isn't
it? Absolutely.
David, we might call it quits for today. I really appreciate your time, and as always, and thank you to you and the team at Booster for doing such a great job of looking after our clients' investments. And we're really wrapped with the results that have happened over the last 5 years, but particularly this year, and the way that the fund manager has been able to recover for us. So thank you for all the great work you do.
Right, thank you. No, a pleasure. I think what's happened over the last 6 months or year or so is a reflection of really 5 to 10 years of underlying work in getting this right, and I'm very comfortable having been through all of these sorts of cycles before, and far too many in my lifetime to have changed the colour of my hair to now appreciate that I think we've got a really good mix of structural settings in the portfolio that mean that your clients, I think, can sleep relatively easily at night, and as long as they've had a check-in with you periodically to make sure that they're definitely in the right fund and that their risk profile is appropriate for the timeframes and their goals and objectives, then they can just sort of go and enjoy life as much as they can under these challenging times, without having to have the additional worry of, is my money being looked after well?
Yeah, perfect. Thanks again, David. Always appreciate your time.
Talk again, and let's maybe do it again less than 5 months' time.
Well, yeah, let's try and do another one before the end of the year. That'd be nice, just to quick wrap up.
Yeah,
good. Thank you. And we'll wind things up there. And thank you all for your time to view this. If you have sat through the whole call, we'll do another one again soon. All the best. Stay well.